Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnina with NinjaTrader. It is August 10th. We have an awful lot of stuff to talk about. A great show today. Before we go too far, I do want to remind everybody, trading futures, options and futures involves substantial risk of loss, not suitable for all traders and investors. Oftentimes in futures trading, you have a large combination of leverage and volatility. And although that can be an equation for opportunity, also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I can afford to lose doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. We make bad decisions when we're under stress as human beings. So be in a good spot. Micros could be your friends. Also, keep in mind of that as well. Don't have to max out on those day trade margins. You got plenty of leverage as it is trading futures. And any questions on that kind of stuff, feel free to type it into the chat. We'd be glad to address it going forward. And lastly, past performance not indicative of future results. And that's it, guys. Thanks for being here. And, today we have Bobby Iaccino is with us today, co-founder of Path Trading Partners, co-host of Futures Edge broadcast with a podcast, rather. It's on Spotify. Awesome show with Jimmy. And frequent media personality, CME Group contributor, all sorts of background and knowledge and information. Thanks for being here, Bobby.
Good to be here, Jimmy. That's a long introduction, man.
Well, you got a lot of credentials. This is the great thing about sitting in my seat. I don't have to be very smart. I have got you to be very smart, and I'm comfortable with that.
A lot of pressure, my friend.
No, it's not. It's not. So we're going to kind of focus this morning on this whole phenomenon, Bitcoin, Ether, these types of new futures asset classes, I'm going to call them, and talk about those, how to trade them, what they're correlated with, outlooks and stuff like that. And at the end, we'll talk a little bit about CPI since it's the big elephant in the room.
Absolutely.
So, we have a bunch of different micro Bitcoin products, a regular Bitcoin product, a nano Bitcoin product. We got Ether futures as well, and they seem to be here to stay. I think these types of these particular products.
Yeah, so I have to compliment the CME Group on putting these products together. They did something that I thought was really, really intelligent. At first, I thought that the CBOE product was better because it was sized more correctly for the retail trader who tended to be the person who was involved in this, but I liken it to Tesla. What Tesla did that was very smart was they came out with $100,000 car first. And then from there, they built down. And that gave Tesla this sort of luxury branding that maybe the Prius didn't have at the time. And it helped Tesla. And the CME did the same thing. They came out with an institutionally sized contract first. And what to me was smart about that was they aggregated a bunch of Bitcoin feeds into one index price. And that's what these contracts are priced to. So sometimes, depending on whatever cash exchange you're looking at, whether it's Coinbase or Kraken or something else, you might see a little bit of divergence between the price of the Bitcoin or the Ether on the futures from those particular exchanges. And I actually know some people that have written programs to arb the differences in those exchanges. So you have another layer of high frequency arbitrage involved in the cash that you don't have involved in the futures. And then from that institutional sized futures contract, they came out with the micros. And the micros are what honestly we all trade. I have a fairly good sized futures account, and I trade the micros because you can simply size up, size down, scale in, scale out. It's the same thing we talk about with all the micro contracts. And these particular contracts are doing extremely, extremely well. They're sized correctly, in my opinion, for the serious retail traders. Then, of course, Coinbase has the nano as well, which helps the smaller trader. But for the same reasons, I think the micro futures are sized correctly to the advanced retail trader.
Yeah, no, I agree, and it gives it's a different flavor. Whatever is appropriate to you, you have that option to trade any of those three. And by the way, Boris is going to be on the show. He's in charge of the Coinbase derivatives effort here, and we're going to talk about nanos, which from a volume point of view have been extraordinarily successful launch. So we have our eyes on those as well as the micro Bitcoin at the CME.
Yeah, I've watched your show with Boris. Nobody knows more about this stuff than he does.
Yeah, so it's good. It's all good. But Bitcoin is correlated to other markets, and I know when you think about, is it an asset? Is it a security? What is it? There's definite correlations that are sometimes temporary, sometimes long-term. A lot of folks are saying, well, it's correlated to the NASDAQ. Well, not always, but let's take a look at some of those correlations, right?
Yeah, it's funny. So I've been interested in cryptocurrencies for, I don't know, about 5 years now, maybe 4 years or so, to the point where I talked about Bitcoin so much that one of my regular TV spots started calling me Bitcoin Iaccino, which I don't think really works, but whatever. That's what they started calling me. Cryptocino was out there. It was really, to me, a tradable asset. And crude oil, which I'm known for, I worked in the oil industry for a period of time. I trade energy probably more than I trade any other futures, not more than I trade stocks and ETFs, but more than any other futures that I trade. But yet, crude oil was the most volatile thing you could trade prior to the advent of the crypto space. So I really love this space. And again, with the micros. So Bitcoin, for me, I said about 3.5, 4 years ago on some interview, I couldn't tell you which one, that I thought cryptos were here to stay, but I didn't know if Bitcoin was MySpace or Facebook. I wasn't sure which one it was. And I said probably a year and a half ago, it's Facebook. Bitcoin is Facebook. Bitcoin is not going anywhere. It's the largest. It may not be the best. I think we all agree. If you're looking at the social media space, Facebook isn't necessarily the best anymore. But when you look at it from a perspective of crypto, Bitcoin is the largest. It's likely to be the most sustainable. Ether is the building block for a lot of things. These are two very, very good products. But Bitcoin specifically has been highly correlated to the NASDAQ as of late. And if you look at a NASDAQ chart overlaid over Bitcoin or next to Bitcoin, you're seeing a very substantial correlation between the two. Now, it broke down fairly recently, but it didn't break down directionally. It broke out in sort of the magnitude of moves. So you still had NASDAQ higher, Bitcoin higher, NASDAQ lower, Bitcoin lower, but Bitcoin wasn't really capitalizing on those moves. And a lot of it was more about some of the problems that cryptos in general were having with some of the exchanges and with some of the stable coins. And I think some of that stuff still has to shake out before we sort of get back to the idea that Bitcoin is either going to be a currency or a high beta store of value. I lean more towards the high beta store of value, in which case it would be sort of a replacement for gold rather than correlated directly to the NASDAQ. But at this point, what you have is a scenario where the people who would invest in technology would likely invest in Bitcoin. So when the NASDAQ was selling off, people were selling everything. When they were getting back in, they were getting back into their lead asset, which would be the NASDAQ. And the Bitcoin would be the follow-up to that, not necessarily the core asset for a lot of these investors.
Now, do you think that relationship is more because of the type of investor that invests in those two products, or just general?
Yes. I don't even need to know what the other option is. To me, it's more about, so like somebody who would like technology would be interested in blockchain technology and would likely make some sort of, express some sort of an opinion into Bitcoin as well. If they believe in technology and they believe tech is the future, and I'm one of those people, when I start looking for things to buy in a scenario where we're in a bear market, we are still in a bear market. I want to stress again that the definition of a bear market is what we are currently in. And the only time you're out of a bear market is when you make new all-time highs. Now, that doesn't mean you can't make money to the long side in stocks. Same thing with Bitcoin. I am, full disclosure, currently long Bitcoin. I was long ES the last time I talked to you guys, and I covered that at about 41.50. That's a position I no longer hold in the ES, but I still hold the Bitcoin position, which is why I'm so in tune with the fact that the NASDAQ or the Bitcoin wasn't rallying with the NASDAQ as strongly as it had in the past. It wasn't a proxy NASDAQ position for me. It was more about the pattern that presented itself in Bitcoin. But you're absolutely right. The type of person who would lean toward tech would be interested in blockchain technology and would be interested in expressing that opinion somewhere, maybe that was a little bit more tradable than a stock that might be involved in blockchain technology.
So that's a conventional wisdom, and I that makes sense to me intuitively. Let's fast forward though to after Labor Day, when the Hill is back in session. And again, the chatter is that they are going to create a regulatory framework around this new asset class, if you want to call it that, which should give it some more stability and also press the Fed to come up with to institutionalize it as well. And so those two phenomena could certainly happen in fall. And if that does happen, how is that going to affect pricing and relationships?
So my opinion on this may sound conspiratorial, and I don't mean it to. I want to throw out there, I'm not a conspiracy guy. I like reading them, watching them, chuckling here and there. I think it's very interesting how many conspiracy theories end up true 10, 15 years later. But this particular case for me, regulating Bitcoin from an SEC standpoint is going to do two things, in my opinion. Number one, it's going to stabilize the volatility. So if you're looking to buy Bitcoin and have it be up 46% the next day, unlikely to happen with regulation, okay? Because some of the speculation that could be suspect will be taken out of the market. For example, a lot of the stable coins were part of the reason that crypto in general and Bitcoin specifically was going up. Some of these off-name altcoins would trade. They would trade into Tether. Tether would then convert to Bitcoin, and that would be part of the bid. And that'd be part of the reason that, and by the way, I'm making these numbers up, but maybe Bitcoin had a fundamental reason to be up 1%. And it was up 11 instead. Okay. And it was because some of these unregulated transactions were in there. Those would likely be restricted in some way, shape, or form. The second part of that is when the Fed comes up, and this is when the Fed comes up with a digital currency, there's likely to be, what's the right word, a lack of trust in that particular digital asset, simply because one of the attractions of people to blockchain and crypto is that it's decentralized. You are not decentralized if you are created by a central bank. Okay. I mean, obviously the word is almost interchangeable there, a central bank and decentralized. Decentralized doesn't mean avoiding the central bank. It means avoiding an intermediary, but a central bank is the ultimate intermediary. So there's likely to be less excitement about that particular digital asset. I think what the Fed wants to do is take over the stablecoin role and not necessarily eliminate the larger and more reliable and more proven cryptocurrencies like Bitcoin and Ether, and honestly, to a certain point, some of the other big names that I don't think we need to talk about here.
Yeah. And so the beauty of what we're talking about, though, is it doesn't matter that much really where that needle sways, because we have futures products that are CFTC regulated with certain, collateral requirements, the whole thing, that should give traders a little bit more comfort that, hey, this is a legit place to express my opinion, whether it's long or short, it doesn't matter. And you have this place with some, volatility, with some volume, with relatively tight bid-ask spreads, which will increasingly get tight. And these are the markets we're looking at today.
Right. So the interesting thing to me, another compliment to the CME, is they, to me, were the first one to legitimize this as an asset by coming up with a futures contract that you can hedge your exposure with. It wasn't Saylor, it wasn't Novogratz, it was the CME to me. Okay, because when the CME created a product where hedging was now possible by some of these big names, well, now you sort of at least gave the opportunity to take away some of the big blowups that could happen. We're still seeing blowups, and these are likely the people that thought using the futures product was kind of going against their ethical stance on currencies and central banks. But to me, when I held actual Bitcoin, and I'm on record as having sold in March. I remember I was telling one of the people in one of my TV interviews, I have sold all my Bitcoin, and it was sometime in late March. I could pull up when, but it's not important. I still am involved in trading the upside of Bitcoin through the futures contracts. I'm not interested in holding the actual Bitcoin at this point because of some of the things we talked about, some of the stablecoin problems, some of the exchange problems, some of the smaller exchanges, and some of the issues from a regulatory standpoint. But the futures are still here for me from sort of a speculative point of view, short to medium term, which again is why I'm long Bitcoin right now. There was a pattern there. The pattern is very clear to me. It had a very clear target for any number of reasons. So I have a long Bitcoin position right now. I always feel I need to throw that out there so people don't think that I'm, just speaking from a point of no interest in this at all. I do have an interest in Bitcoin going up personally right now.
So that begs the question, is technical analysis way more important in this market versus everything else versus fundamentals? Yes. Because it is what it is?
Somebody explain the fundamentals to me in Bitcoin. Like, I understand the blockchain. I understand the relationship of the currencies that are attached to a blockchain and why that's valuable. I don't understand staking. I don't have any interest in really understanding that, because that to me seems like whenever the risk-free yield is at 2%, 3%, and these people who are staking in the cash market are earning 10, 12, 13, 14%, you can never separate risk from reward. Simply can't be done. People have tried for years to take only the reward and detach themselves from the risk. Can't happen, doesn't happen. So if the risk-free rate, which is of course the rate of treasuries, currently the 10-year note's at about 270. So we'll call 2.7% the risk-free rate. And you can stake in the cash market and earn 10, 11, 15%. There's too much risk there inherently. I don't care what anybody says. So from a perspective of what the futures actually do for you is it allows you to look at pure price action and pure technical analysis. And that, of course, is to me, look, fundamentals to me are fun. Okay, I like to see if I'm right about what I think the path of the fundamental side of the market is.
Yeah, just to interrupt a little bit, just to explain a little bit more my thought process. You're right on point. Is when you look at the crude oil market, you have external factors, supply, demand, supply chain, all distribution, distillation, all that stuff to consider, as well as price action, right?
Yeah, well, I've actually committed to one of our clients to do a video about the fundamentals of crude oil, what matters. And I'll probably do that video sometime in the next week or so and post it on Path Trading Partners YouTube. But it still doesn't matter, because fundamentals are based on what I think the market thinks. So in other words, if there's a big draw in crude oil, okay, wow, that's less supply, market should go up. But if the market was expecting a bigger draw than actually came out, the market will go down. So fundamentals they're juxtaposed with price action. I always say that price action is the steering wheel and the fundamentals are the gas pedal. I want to be pointed in the right direction when the fundamentals come out. And that's what price action does for you. Price action, whether you know it or not, is showing you what the market thinks should happen. And the market is right more often than it's wrong. So in the case of Bitcoin, for example, we had a technically correct double bottom. Technicals are much more important in crypto than anywhere else, because I don't know if I'm right about the fundamentals. It's such a young asset. It is such a young asset class that what are the fundamentals? One of the fundamentals is there's a limited amount of Bitcoin and 91% of them have already been mined. So there's only 9% of the total Bitcoin that will ever exist left to be mined. That's a fundamental. Well, that means up all the time, never stopping, always going up. And that's not what's happening. So there's other fundamentals, whether it's regulatory, whether it's problems with stable coins, whether it's adaptability and people actually using Bitcoin, adoptability, which is another phrase. I don't understand those fundamentals. Price action, though, as I've said to you before, Jim, the only thing I know for sure is that Bitcoin is currently trading higher than 21,000. And that can't be incorrect, right? Because we see it on our screen. It's the only thing we know for a fact. Where is it trading right now?
Let's pull up the charts right now. And by the way, I like that you said that about the correct and incorrect. I hate the term, the market's in correction right now.
Yeah,
it's never incorrect. It's always correct, right? It's not incorrect.
It's always right.
But I have a few charts up here. Upper right-hand side is the micro Bitcoin daily chart. I have on the left-hand side a daily gold chart, lower left daily Euro FX chart, and lower right the micro NASDAQ daily chart.
So one of the things that you would expect to see, and we'll look to the Euro chart because that's the most important of the dollar-related basket of currencies. When you look at, for example, the dollar index, it's basically the Euro. Okay. The euro is the heaviest weighting in the dollar index. And whenever I have an opinion in the dollar, I trade the euro currency futures. And we're seeing that just pop up to that. I believe that's the 50-day moving average in the blue. There's a breakout. You have those two box areas that frame out that sort of sideways channel. And we have a breakout of that channel, a strong breakout. No, I'm not involved in that particular one right now. But when you look at the Bitcoin, more dollars in the market, which is what a weaker dollar is, right? It means more dollars out in the market. And we could trace that to CPI if we'd like to. CPI came out lower than expected. So people think the Fed is going to raise rates less aggressively, if at all. That means more dollars in the system. That means the euro gets stronger and Bitcoin follows that as well. You would rather see Bitcoin correlate to a currency than to an index. Right now, it correlates stronger to the NASDAQ than it does to euro. But you can see with these two charts side by side that you see a fairly good correlation there as well. It's probably somewhere in the range of a 0.7 or a 0.8, where with the NASDAQ, it's been as high as 0.95. So that's one of the things there. Now, what I'm looking at with my long Bitcoin position is the double bottom that was formed with the bottom of July 1st and then the other bottom at July 13th. Okay, so you have two bottoms there. You have a down move that preceded those bottoms being made. Okay, and that down move started on around June 7th, and that's the collapse, the June 7th down move right there. Okay, there's the two bottoms you're marking with the arrows. Thank you for that. You have the requirement of a down move that led to that double bottom being formed. And again, that started about June 8th or so and finished with the bottom that you just marked off. Okay, so there's your down move. And then you have the peak, which is July 8th. Okay, so that high on July 8th formed the peak of the double bottom. All right, now we got to close above that double bottom on looks like July 19th from what I'm looking here. All right, that's my signal that the double bottom is now confirmed and triggered. Now, what I try to do on these, I don't jump in on that. Okay, what I try to do is buy a pullback. And that's what I did. I ended up buying Bitcoin futures on about 410, right around there, on the pullback that we got over the next 4 days or so. That's where I bought. Okay, 410. And my target is the measured move. So what does that mean? Well, if you measure out the difference between the July 13th low and the peak on July 8th, and add that to the high of July 8th, you get about 26,400 as a target. Okay, so that's where my target is for this particular trade, 26,400. All right.
So that's a very mathematical formula, given this kind
very
of
mathematical.
This upside down V shape that we were just talking about.
Yeah, now there's some caveats. For example, if that 26,400 measured move reached above this, I want to say this very clearly because this is kind of hard to understand when I'm saying it. If that 26,400 measured target was higher than the move that led to the double bottom in the first place, so that down move that started at about June 8th or so, if my target were higher than that, the trade is negated. Okay, it's negated because now my measured move is higher than the move it's actually correcting. So that is not likely to succeed. The second thing is my target is below that gap you see there, the gap from June 10th to June 13th. See that gap right there? Now that gap is likely to fill. It's just the way gaps work. But my target is prior to that gap. If my target would have been above that gap, so in other words, above the close on June 10th, if my target were above there, I would have lowered my target to the gap. Because what happens when a gap is filled is it tends to reject that area. It doesn't always stop there, but it does tend to reject that area. When I set a target, I want that target to be an area that I think price will reach. Okay, I'm not looking to sell the ultimate high. I've been doing this almost 30 years. I can count on one hand the amount of times I've bought the low and sold high. It's 4 times total. In 30 years, 4 times.
It's impossible to do.
About that. I know. I don't care about that.
I'm used to blind squirrel gets an acorn once in a while.
Yeah, exactly. So that's my trade here. My stop is at, I actually got to zoom in on this to see this. My stop is at about 20,305. That's where my stop is on this particular trade. So I'm at about 1.2 to 1 reward to risk on this particular trade. And there's obviously a reason for the stop as well, but we don't have time in this to go through it. But it's 20,305 is the stop.
So, all right. So I do want. All right. On that note, though, by the way, when you have those risk reward ratios, do you have risk reward ratios fixed in your head, or no? You just want to look at the math and the structure.
So what we try to do is we try to get a win rate higher than 50%, and our minimum reward to risk is 1 to 1.
Okay.
So if it satisfies those two criteria, higher than 50%, risk to reward better than 1 to 1. As long as I am strict with that, over the long term, I should make money. I don't want to say over the next 10 trades or anything like that. I'm not trying to mislead anybody. Yeah. But with these particular double bottom patterns, when they are technically correct, which this one is, the win rate is almost 60%. Okay, it's about 59 point something. So that combined with around a 1.2 reward to risk, over time, we should be good on this over time. Awesome. Now, remember that I got to throw this out, Jim, and I'm sorry to jump in again, but
that's right.
When you have a 50, let's call it 60%. When you have a 60% win rate, that means out of 1,000 trades, I could be wrong 400 in a row and not break that. Okay. So I never want people to be like, this is a 60% win rate. I should triple my risk. Do not do that. Okay. You should always have your risk under control. And as Jim mentioned at the beginning of the show, leverage can be a very scary thing. You think it's 60%, I'm going to lever up. Don't. It's a bad idea.
Hallelujah, brother. I agree 100% with that concept. And I know this is good. I'm going to get a little bit off script right here, but let's spend the last couple of minutes talking about CPI and then tomorrow's PPI, and talk about the actual number and kind of the impact. And it was a good, bad in reality.
So quick note on PPI. PPI didn't matter for a long time because companies, even if PPI was higher, they were not passing the cost down to consumers. PPI matters again because PPI will tell you if this trend of slower growth of inflation is likely to continue. So it matters. CPI, obviously this was good news for the markets. The markets took it as good news. So did yields. The 10-year yield, for example, was up 2 basis points before CPI. It's down 10 basis points now. Okay, so yields fell. We're still not at the lowest levels of August, by the way. We had a 263 and a 269 settle in the month of August on that 10-year. What I want everyone to focus on is a couple of things. The consumer price index is an index, okay? So if you go to the St. Louis Fed's website, it's their FRED website, and you type in consumer price index, you will notice that that curve is straight up. And it's all about the steepness of the curve, okay? Now, recently, the curve had gone like this, and then it did this, okay? So you have a CPI, the consumer price index was going up all the time, and then it just shot straight up. When people talk about peak inflation, inflation is not currently coming down. This particular set of numbers tells you that it's going up at a slower rate, but it's still going up. So it's one of those phrases we use in active trading and investing in finance. Peak inflation means peak rate of change of inflation. Inflation still rose 8.5% year over year. It was flat on the headline month over month, but it was still up 0.3 on the core, which matters more to the Fed. CPI, consumer prices, are still going up. They're just going up slower. And then lastly, in that strong non-farm payrolls report, we saw wages higher than expected. That's the biggest part of prices is wages. And with productivity being at the lowest level in a decade, that's likely to drive prices higher in the future, even though we got an easing of commodity prices, fuel prices, and ags.
So some turbulence maybe going forward. I do want to take a peek at that Euro FX chart in this note, because we had German CPI and Italian CPI coming out, I think 7.5 and 7.9%, respectively today. And we came out, and then we have this huge Euro FX spike right here. This is telling us something, right?
Yeah, well, the month over month German came out as expected, up 0.9%. Remember, since the pandemic, the EU has been mimicking the US, but it's been about a month or two behind. So I suspect as people talk about peak inflation, which again, they're talking about the rate of change of inflation, we're probably not there in ECB yet.
Yeah, interesting. German numbers are always right on point. Somehow they always predict it almost exactly. It's amazing.
Everything German. If you've ever driven a German car, they have a different way of tightening screws, man. They're just good at that stuff.
Yeah, no, for sure. Well, I think we're out of time here today, but I do want to give everybody an opportunity to know how to get a hold of you, how to follow you on the various places that you're at. I love the podcast that you and Jimmy do. By the way, I listen to it all the time, On the Treadmill.
Yeah, we have a really good, really interesting guest coming up, Dave Cullum, who's actually a biology and chemistry professor at Cornell, but he's very active in economics on Twitter and on social media. He's a very smart guy, reads data really well. He'll be on this week, which will be released on Monday. You can find the Futures Edge podcast on Path Trading Partners YouTube channel. It's one of the videos on that channel, or on the free version of Spotify. I always have to tell everyone, you could download Spotify. It's the free version that our podcast is on. You don't have to pay anything for the Spotify subscription. Again, that's the Futures Edge podcast. So please check that out. And then you can find me on Twitter. I'm pretty active, Bob_Iaccino. If you don't know how to spell my name, I don't even know how to spell my name.
It's on the screen. It's on the screen.
It's on the screen. So it's not that easy to spell. Also, pathtradingpartners.com. You could directly hit the support email and that stuff will come to me as well. But subscribe to the Path Trading Partners YouTube channel, because there's a lot of me and Jimmy and my partner, Mike, who does a ton of technical analysis every day for free on that YouTube.
Awesome. Thank you so much for spending time with us today. Always a pleasure. Looking forward to next time. I appreciate you being here.
Good to be here, buddy.
All right, everybody. Thanks for coming. Appreciate your participation. Appreciate the thumbs up on the YouTube channel, by the way. Greatly appreciate that. And please, most important message of the day, be safe out there. Be good to each other. Thank you.